Your phone buzzes at 11:47 p.m. Friend. Bro, stocks are gambling. I'm keeping cash. At least it's safe. You stare at your bank balance like it's a security blanket and feel weirdly proud. By the end of this, you'll see the exact gap cash creates, how compounding quietly bullies it, and what to do tonight, whether you're broke, stressed, or already earning decent. Because yeah, keeping cash feels smart. Cash is clear, cash is calm. Cash doesn't swing up and down and ruin your mood at lunch. In South Asia, cash also means control. You've seen people lose money in scams, relatives invest in a cousin's genius business, and someone's sure thing plot file turn into a 10-year headache. So your brain goes, no drama, just save. I'll invest later when I have more. That belief makes perfect emotional sense, but there's a hidden mechanism working while you're sleeping. It's not the stock market, it's not even risk, it's time, multiplied by inflation, divided by hesitation. And the villain of this story is the compounding gap, the space between money that grows and money that just sits there getting quietly shaved. Pause. That shaving doesn't look like someone stealing from your pocket. It looks like groceries getting a little louder. It looks like rent getting bolder. It looks like the same phone costing more next year, while your safe cash is still doing push-ups in the corner. Let's make it painfully real with one tiny story. You're 24. You start earning, you decide you'll save $10,000 a month, not a fantasy amount. Just, I can manage this if I stop ordering biryani like I'm a prince. You do it for 5 years. That's 10,000 x 60 months, Torgazern 600,000. You're proud. Your family's proud. Your bank app sends you those little fireworks. Now 2 paths. Path A, you keep it in cash, like literally sitting in a savings account or under the mattress mindset. Path B, you put it in a boring, broad index fund. Basically a basket that owns tiny pieces of many big companies, so you're not betting on one hero stock. We're not using magic numbers, just plausible illustration. Say your cash grows at 4% a year in a decent savings situation, and the index fund grows at 10% a year over the long run. Some years it will be ugly, some years it will be ridiculous, but we're talking average. Here comes the first mini aha. The gap isn't 6%. The gap is your future lifestyle, because your money doesn't grow once. It grows, and then it grows on what it grew. That's compounding. Cash compounding is like a treadmill on low speed. Index fund compounding is like a moving walkway at the airport, and then you start jogging. Now the math reveal, with no headache. If you put $600,000 in cash at 4% and leave it for 20 years, it becomes about 1.3 million. If you put $600,000 in an index fund at 10% and leave it for 20 years, it becomes about 4 million. Same starting money, same years, different engine. And you're like, okay, but I'm not starting with 600,000. Fine, make it smaller, even 100,000. At 4% for 20 years, around 219,000. At 10% for 20 years, around 673,000. That's not a rounding error, that's a different life. Second mini, aha. Time is not neutral. Time punishes the option that grows slower. Now the third mini, aha, and this one stings. Inflation means your cash is also running a reverse compounding in the background. If prices rise 8% a year and your cash grows 4% a year, you're not growing. You're shrinking, politely. Your bank doesn't show 4% purchasing power in red. It just smiles at you. And that smile is a marketing strategy. Quick detour, your brain is probably saying, okay, but my uncle kept cash and bought a plot. He won. True. Sometimes cash wins because it gives you timing and bargaining power. When the seller is desperate, the person with liquid cash looks like a superhero. So yes, cash has a superpower, but it's a short-range superpower like a torch. Great for the dark room you're in right now. Useless for building a power plant. The mistake is turning that torch into your retirement plan. Think of it like this. Cash is a seatbelt. Index funds are the engine. A seatbelt saves you in a crash, but nobody finishes a road trip by hugging the seatbelt and refusing to start the car. Now zoom out to a very South Asian reality. Currency drama. 1 year the rupee is fine. Then you blink and the dollar rate is doing parkour. If your long-term money is only sitting in local cash, you're not just fighting inflation. You're also fighting currency depreciation, the value of your money compared to the rest of the world. That's why your cousin in the Gulf sends remittance and suddenly your family treats him like he owns the central bank. Same work, same salary, different currency. It's not personal. It's math wearing a suit. Broad equity index funds, especially ones that have global exposure, can act like a partial shield. Not a perfect shield, but a shield. Because big companies earn in multiple currencies and sell to multiple countries. Your cash earns vibes. Micro story time. Meet a deal. Because every finance story has an Adil. Adil is 26, working in Karachi, and he saves $15,000 per month. He also loves certainty, so he keeps it in cash. After 3 years, he has about $540,000 saved. He's proud. His mom is proud. His bank app is basically his best friend. Then Adil decides he wants a car. Not a fancy one, a reasonable one. The price is $2.2 million. He says, "No problem, I'll just save 2 more years and I'll be there." 2 years later, that same reasonable car is $3 million. Adil's cash didn't fail him. The finish line moved. That's the compounding gap wearing a car showroom smile. Now rewind, same Adil, same savings, but he splits it. He keeps $200,000 as emergency cash and starts investing the rest monthly into a broad index fund. Year 1 is annoying. Market goes down. He feels stupid. He feels like messaging that friend, "See? Gambling." But he keeps buying because it's automated, and because he promised himself he won't treat investing like a mood ring. Year 3, the market recovers. Year 5, he checks and realizes the annoying year bought him cheap units. Not a heroic moment, a boring moment. And boring moments are where wealth hides. Another quick math reveal you can do on a napkin. The rule of 72. Take 72 and divide by the growth rate, and you get roughly how many years to double. At 4%, 72.4 is 18 years. At 10%, 72.10 is about 7 years. So cash doubles like a slow bus that stops at every corner. Growth assets double like a metro. Still stops sometimes, but it actually moves. And this is where your emotions try to sabotage you. When cash is your plan, you feel disciplined. When an index fund is your plan, you feel exposed. Because the number can go down on your screen. But screens are liars. They turn long-term plans into daily drama. They make you judge a 20-year journey with a 20-minute mood. Pause. Stop checking your money like it's your ex's Instagram. Here's another trap, the lump sum fantasy. You tell yourself, "I'll invest when I have a big amount." So you wait. You keep cash. You keep waiting for the perfect moment. But the market doesn't send invitations. While you wait, you miss the early compounding years. The years that matter most. All right. Starting early with small amounts beats starting late with big amounts more often than your ego wants to admit. Let's do a simple comparison. Person 1 invests $10,000 per month from age 25 to 35, then stops completely. Person 2 waits, invests nothing in their 20s, and then invests $10,000 per month from 35 to 55. Same monthly amount. Person 1 invested for 10 years. Person 2 invested for 20 years. Guess who often ends up with more? The one who started earlier and stopped. Because money needs time more than it needs your effort. That feels unfair. It is unfair, and that's why you should use it. And don't forget the other silent villain, fees. Fees are the termites of wealth. You don't notice them the day you buy. You notice them 15 years later when your returns feel meh, and you can't explain why. A fund that charges high fees can quietly eat the very compounding you came for. So your job isn't to find the best fund. Your job is to find a broad, low-cost fund and then get out of your own way. One more catch moment. People compare cash to stocks like it's a fair fight, but they forget cash has a guaranteed enemy, inflation. Stocks have uncertainty, yes, but historically businesses tend to raise prices when inflation rises because they have to. That doesn't make the market safe. It makes it adaptive. Cash is stable, but it's not adaptive. It's a statue in a storm. Your inner monologue right now. Okay, but what if I invest and then need money suddenly? That's why you separate buckets. Emergency bucket, cash. Opportunity bucket, cash you can deploy when something is cheap. Growth bucket, index funds. When you mix all three into one pile, you panic faster. You sell at the worst time. You swear off investing. Then you repeat the same cycle like a tragic playlist. Another inner monologue. I just want a simple rule. Tell me the rule. Fine. If you might need it soon, keep it in cash. If you can leave it alone for years, put it where it can grow. Your future is not funded by comfort. It's funded by boring consistency. And if you're thinking about faith-based concerns like, is this even okay for me? Different people follow different rules, but the compounding gap doesn't care about your intention. If you choose a screened equity fund that fits your principles, the concept is still the same. You're owning real businesses instead of parking money in a shrinking pool. The point is growth versus stagnation, not one brand name. Now here's the part nobody wants to say out loud. Keeping cash can be a form of procrastination that looks responsible. It's socially approved procrastination. Your relatives will never criticize you for having money in the bank. They will criticize you for investing and losing money in a bad year. So you choose the option that protects your reputation today. But your reputation doesn't pay your future bills. Pause. Reputation is expensive. One last proof to stack the argument. Imagine you keep $1 million in cash for 15 years. Your account may show more later, sure. But if inflation averages 8%, prices roughly double in about 9 years. So in 15 years, many costs can be around 3 times higher. Your 1 million is now emotionally big, but functionally smaller. It's like bringing last year's umbrella to a cyclone. Technically an umbrella, practically a joke. Meanwhile, if your money is in growth assets, it's at least fighting back. Some years it loses ground. But over long periods, it has a chance to outrun inflation. Cash doesn't outrun, it just survives. And survival is not the same as progress. And a quick myth grenade. I'll jump in when the market looks safe. If you wait for safe, you usually buy after prices have already climbed. The market's best days often show up close to its worst days, like weird neighbors. So the person who keeps cash waiting for a green signal can miss the bounce that does most of the recovery. That's why simple monthly investing works. It doesn't predict, it participates. Pattern interrupt. Trying to time the market is like trying to catch a falling knife while blindfolded. Okay, back to our main path. Also, don't confuse diversified with complicated. Diversified just means you're not betting your whole future on one company, one sector, or one friend's hot tip. It's the financial version of not putting all your biryani on one plate at a wedding. Boring wins. Your ego hates it, your wallet loves it. Pause. This is where people say, but index funds can go down. Yes, they can. That's the price of the growth engine. But cash goes down too, just slower and sneakier. Imagine 2 elevators. One elevator has shaky lights and sometimes dips a floor, but it's designed to go up the building. The other elevator is smooth and quiet, and it's slowly going down. Most people choose the quiet elevator because it feels safer in the moment. Then one day they look up and realize the lobby is above them. Now let's talk psychology, because your brain is the real decision maker here. Humans hate loss more than they love gains. A 10% drop feels like betrayal. A 10% gain feels like nice. So when you see the market fall, your mind screams, get out. But when inflation eats your cash, your mind whispers, it's fine, because the pain is invisible. This is called loss aversion, and it's why the compounding gap wins. It doesn't need to scare you, it just needs you to delay. And delay has a cute name. I'm waiting for the right time. That right time is usually after prices have already gone up, and your confidence has been rescued by other people making money. Pattern interrupt. Your biggest investing risk isn't the market, it's your calendar. Now, a quick micro scene to show how this plays out in real life. You're 29. You've saved $200,000 in cash over a few years. You feel solid. Then suddenly, marriage pressure, or your parents need medical help, or you decide you want to move to a better area. You open property listings and your brain starts buffering like weak Wi-Fi. The same flat that was $6 million is now $10 million. Your $1.2 million didn't become useless, but it became small. So you take a loan, and now the monthly payment illusion enters like a villain with a fresh haircut. Monthly payment illusion is when you buy based on, I can afford the installment, not on, I can afford the total cost. It's the reason people feel rich while becoming trapped. It's also why many stay cash heavy. They want a down payment and fear volatility. Fair, but here's the catch. If your down payment is sitting in cash for years, it's losing the race against rising prices. You're trying to fill a bucket while the bucket is growing bigger. Pause. That's the compounding gap. Okay, objections time, because you're thinking them right now. Objection 1. What if the market crashes right when I invest? Valid fear. Answer: don't invest money you need soon. Your short-term goals should be cash-heavy. Emergency fund, next 6 to 12 months expenses, upcoming tuition, wedding expenses, any amount you'll need in a year or two. Keep that in cash or safe instruments. Index funds are for the money you can leave alone for at least 5 years. Not because you're weak, because time smooths the bumps. Objection 2, but I don't trust brokers and apps. Also fair. There are shady players. So simplify. Use regulated platforms, stick to broad funds, and avoid anything promising guaranteed huge returns. The boring option is the one that survives. Objection 3. I'm broke. I can't invest. Listen, if you're broke, the goal isn't to become Warren Buffett. The goal is to stop bleeding and build a tiny growth habit. Even small amounts matter because you're training your identity. I'm the person who plants money. Now the math again, but with a monthly habit, because that's how most people actually build wealth. Say you invest $10,000 a month for 20 years. At 4% average, you end up around 3.6 million. At 10% average, you end up around 7.6 million. That's more than double. Same monthly effort, different outcome. That's the compounding gap paying rent in your life. And before you say 10% is too optimistic, remember, this is illustration, not a promise. If returns are lower, the gap shrinks, but it doesn't disappear. Because the core point stays, higher growth plus time, a widening gap. And cash has inflation pushing it backwards. Now, you're probably thinking, I don't want stress, I don't want to watch charts all day. Good, you shouldn't. Index fund investing is supposed to be boring. If your investing plan needs daily attention, it's not a plan, it's a drama series, and you are not paying subscription for that. So what do you do tonight? 2 versions. If you're broke or overwhelmed, step 1, write down your survival number. That's your bare minimum monthly expenses: rent, food, transport, bills, family support. Step 2, build an emergency buffer of 1 month first, not 3 months. 1 month, keep it in cash, because peace is a financial asset. Step 3, kill one leak, just one. The sneakiest leak is subscriptions and food delivery. Pick a number you can save without feeling tortured. Maybe $1,000 or $2,000 a month. Step 4, automate that into a basic index fund or low-cost diversified fund, even if it's tiny. Yes, tiny. This is you building the muscle. Step 5, for the next 90 days, do not touch it. Not because you're perfect, because you're training your nervous system to not panic. And here's a line you need to hear. You don't need confidence to start. You need a system that protects you from your own mood. If you're stable and ready to optimize, step 1, set your emergency fund to 3 to 6 months of expenses, depending on job stability and family responsibilities. Keep that in cash or safe instruments. Step 2, separate your goals by time. 0 to 2 years, mostly cash. 3 to 5 years, mixed. 5+ years, mostly growth assets like broad index funds. Step 3, automate investments on payday, not at month end. Month-end investing is like eating healthy after the wedding season. Nice intention. Rarely happens. Step 4, make fees your enemy. High fees are a silent tax that compounds against you. Even a 2% extra fee can steal a shocking chunk over decades. Step 5, increase your monthly investment by a small percentage every time your income increases. Not a huge jump, just a gentle upgrade. That's how you beat lifestyle creep without feeling deprived. Pause. Lifestyle creep is when you're spending upgrades faster than your goals. New salary, new phone, new coffee habit, new I deserve it. And suddenly your savings rate is still the same. Your future you is watching like, so, we're doing this again? Now, one more twist people miss. Cash is not the enemy. Cash is a tool. It's for stability, flexibility, and short-term certainty. But using cash for long-term growth is like using a screwdriver to cut a cake. You can do it, but it's messy, slow, and everyone's confused why you're struggling. The compounding gap exists because growth assets scale with time and cash scales with nothing. Cash is a photo, index funds are a video, and time only rewards the video. Let's go back to that midnight text message. Your friend says, "At least my money is safe." You can reply calmly, "Safe from what? Safe from market swings? or safe from your
all
future.
right. I'm
Because
going.
the
I'll get
real
the key
danger
right now.
isn't a red day. It's waking up at 35, 40, 45 and realizing you did everything
Time is not
responsible,
neutral.
but still feel behind. Not because you were lazy, because you followed the wrong scoreboard. You kept score in rupees, not in purchasing power. You measured safety as no fluctuation, not as my future is funded. Pattern interrupt. Stability without growth is just a slow leak with good PR. So here's your identity shift, and it's simple. You're not bad with money. You were just taught to respect cash more than time. You were trained to avoid embarrassment today, even if it costs you options tomorrow. Different rulebook, different results. You can keep cash for peace, and you can invest for power. Both can exist in one life, but don't confuse the pillow with the engine. Tonight, pick a number, even if it's small. Set the automation. Name it something that makes you smile, like future me doesn't beg. Then leave it alone. Let time do the heavy lifting
Safe
while you
from
live.
swings,
And next time
or-
your phone buzzes with that cash is safe argument,
or
you'll remember the
safe
quiet
from
shaving,
future.
the elevator,
Whoa.
the bucket that keeps growing,
only works
and the
short
monthly
range.
payment
I
illusion
can't
trying
light
to
up the whole
hypnotize
power
you.
plant long
You'll
range with
smile
this.
because you're not holding money anymore. You're building momentum. And momentum compounds, truly.